Yeah, look, I mean, obviously, price leads, right? And the price is telling us that we were in this multi-month accumulation phase, basically started in May, and it's really coming out of it now. You've got a few things happening at the same time, right? You have massive accumulate shortage, right? On crypto is leaving exchanges. There's a net outflow. There's simply not enough Bitcoin to go around, right? You had a whole bunch of levered shorts getting, we use the phrase wrecked in the crypto world, the two kind of basically playing off each other. That was causing the markets to go up and down, which is what you see in a kind of a Bitcoin accumulation phase. We've clearly come out of that to the upside. It just proves that we were kind of in a macro bull trend. And what we thought was a crash was literally what you see when you're in exponential growth, because you've really got to look at the Bitcoin price in a log chart, not in a linear chart, because if the price is just going up crazy. You look at it in a log chart, it basically looks like a straight line up and to the right.
Here's my question, Bill. When I think back about on the past 18 months and the fact, to your point, that it has been pretty much an upward line, what happens when the liquidity really starts to ebb, when the Fed is tapering, at some point raising interest rates, the fiscal stimulus stops from D.C.? How much of that liquidity is built up in something like Bitcoin?
Not much, because there's so few strong hands so far that make up a massive percentage of the overall Bitcoin holding. So it doesn't really yet take a lot of large institutions coming in to drive the price higher. So my point is that if you get slightly higher interest rates, but you still get the kind of accumulation that we're seeing, Bitcoin moving to strong hands, and just a few institutions coming in, hedge funds, the BlackRocks of the world, it's not going to make any difference in terms of what the interest rates are, really.
Right, but I guess I'm even thinking about the retail public, who by and large comprises the existing longs. Some of them were in from the start, and some have gotten in over the past 18 months, fueled by all of this excess liquidity. So I guess once it's in, it's in. And, it's not until things turn around that there might be an issue in terms of people kind of pulling out. But it's interesting to me that so many of these arguments are made for the price of Bitcoin to keep going higher. And I think that the concern really always comes back to, when I ask people fundamentally, aside from the structure of it and all the rest of it, it always seems to come back to dollar debasement. And, I've joked a little bit about this, how kind of Bitcoin represents Austrian economics and the dollar is for the Keynesians, things like that. And I think,
Sure.
That's why I wonder if, a big change in what's going on with liquidity provision could be something that pulls the rug out from underneath the performance of a lot of these cryptos.
Yeah, maybe in the short term, there might be a blip, like, when Elon says he sold 10% as a test. But I think the broader narrative here that's going to drive this higher in like this higher, not like this higher, right? The broader narrative is this is the fastest adopted technology in human history, meaning cryptocurrencies. And it was faster than the internet, faster than smartphones, faster than anything we've ever had. And the network effects are amazing. And when you get to that tipping point, remember, like when Facebook shares were being sold in the secondary market before it went public and people couldn't believe how fast the price was going up, it was all about the network effects. And when you actually look back on those network effects, it was actually predictable. The same thing is happening with Bitcoin now. It just so happens that it's happening at the same time that we're having this global debasement discussion. And so I think the network effects come first.
Interesting.
And the debasement discussion comes second.